Washington National Tax Services Office of Price Waterhouse, LLP. He's written numerous articles on federal, state, and local tax issues in a wide variety of publications. He testifies frequently before state legislatures and Congress on state tax issues and is a frequent speaker at national tax conferences and seminars. Excuse me. Mr. Lindholm serves on the NYU State and Local Taxation Advisory Board, the Advisory Board of the Paul J. Hartman State and Local Tax Forum, the Editorial Advisory Board of Tax Management, Inc. He's a former member of the National Tax Association's Board of Directors and the Advisory Board of the Georgetown University Law Center, State and Local Tax Institute. He's a member of the U.S. Supreme Court and the District of Columbia Bars, which means he's a lawyer. In 2006, Mr. Lindholm was named to the Tax Business 50 list of most influential tax professionals on the globe and is the recipient of the 2009 New York University Award for Outstanding Achievement in State and Local Taxation. He's a graduate of American University's Washington College of Law in Washington, D.C., and Lynchburg College with a BA in Accounting in Lynchburg, Virginia. We're very fortunate to have Mr. Lindholm here. Thank you for coming. And just as fortunate, we're lucky to have Lee Bearlocker from the Montana Department of Revenue here. Mr. Bearlocker is the Income Tax Division Administrator at DOR. He received a BA in Accounting at the University of Montana and has been with the department for 28 years. His division annually collects more than $2 billion in taxes and fees and encompasses nearly 40 different tax types. He's developed audit programs in various tax types and is currently the Vice President of the Multi-State Tax Commission Tax Audit Committee. And he's an avid skier, golfer, and enjoys coaching his children's activities. He resides in Helena with his wife Christy and their 4 children, Brooke, Brayden, Lauren, and Bo. So gentlemen, I'll just let you have that.
Great. Thank you very much. It is a great pleasure to be here. Remind me to send a shorter bio next time, but thank you. It was very kind. Thanks to Bob Story. Bob, where are you? I really appreciate the invite. Bob comes to our annual meeting every year and gives us a preview of what is expected to happen in Montana in the coming year, and it's very well received. And thanks to the folks at the Chamber for helping me get here. What we plan to do in the next we have 2 hours, is that right? 45 minutes. I'm going to do a hard stop after 30 minutes. Lee wanted to do the Montana, we'll focus mostly on personal income changes in Montana, and I'm going to cover how federal tax reform has impacted the state so far. It's been, it's a little over 30 years since the last time that we looked at federal tax reform. And that really dovetailed pretty well with my own experience. I graduated from law school in 1985. And of course, the 86 Tax Act was one of the first things that I worked on extensively after law school. And I was asked to give a presentation to a senior citizen center back in 86, 87 on how the 86 Tax Act impacted seniors. And it was, that's always a tough act, but I put a lot of effort into it, and we didn't have PowerPoint, and I had an overhead projector, and I had all these slides, and I went through a half hour of very detailed implications for senior citizens in the 86 Tax Act. And I thought I'd done a pretty good job. After the presentation, these 2 old ladies were walking up the aisle. One of them was considerably older than the first and was hanging on to the arm of the other. And they came up to me, and the older one looks at me and says, "That was the worst speech I've ever heard." And seriously, I must have looked crestfallen. I was young. Was very public speaking was very nerve-wracking. But the younger one said, "Oh, don't worry about her. She just repeats what she hears all around her." Good about that. I want to say raise your hand and say, stop and explain that. We're happy to do that. Part of the issue, I mean, we do this all the time. We talk tax. Sometimes we talk in acronyms. Sometimes we talk in code sections. Don't let me do that this time. I mean, if you have questions, I'm happy to answer. This is kind of what we want to do, what I want to cover in like 30 minutes, down to 29. I want to first give you a sense that the slide deck, and I'm going to send this to the folks at the Montana Taxpayers so that you can look at this. There's a lot more here than I'm going to get to. But I want you to have the slides so that if you do want to go back and do a deeper dive, you'll have something to do that. First, I want to give you an overview of the federal law and more importantly, what was driving the need for it, because that's critical for understanding or we do a lot of advocacy in the states for trying to convince states how to react to the when they conform to the federal Tax Cuts and Jobs Act. And then I'm going to focus mostly on the corporate side, hit some of the key international tax provisions that impact U.S. companies, and then some of the key domestic corporate tax issues that are impacting states as well. So let me start with major drivers of tax reform. We had the highest corporate tax rate in the world, close to 38%. And this is 2017. We also imposed a worldwide system of taxing foreign earnings. And the way that works is, tax drafters need to be very concerned about double taxing income. So there's two ways to do it. And the way that the feds do it is that did it in 2017 is that they would tax everything a company earned worldwide. And then they would give a credit for any foreign taxes paid on that income when that income was brought back to the U.S. Now, some of that income was deemed to be earned immediately, even though it was earned in a foreign country, because it was income that was easily transferable, easily movable, and very mobile. That's called Subpart F. And remember that Subpart F income, because that's important for upcoming discussion. Well, everything that wasn't Subpart F income, that is income that's easily transferable, was left in overseas, was parked overseas, because companies, if they brought it back, would have to pay the delta between the foreign tax they paid and the U.S. tax. And if the U.S. tax was twice the foreign tax, it made no sense to bring it back. You combine those two, the worldwide tax system with the high statutory tax rate, it created terrible disincentives for companies to invest in the U.S. I mean, if you have a tax system, you want a tax system that creates incentives for growth. And this sort of perfect storm was recognized by, this is a nonpartisan, both the D's and the R's, that were saying, yeah, our system, our federal system is competitive. It is not competitive, and the world has moved on without us. And let me show you what it looked like. That's the U.S. on the far left. These are the corporate tax rates, close to 38%, and the rest of the industrialized nations moving down to your right. The red bars are companies that impose taxation on a worldwide system. And that is, tax everything and then give a credit for taxes paid, foreign taxes paid in countries where it's earned. The blue imposed taxes on a territorial system only. That is, only the income that is earned within that jurisdiction is taxed there. Now, this looks far different from what it looked like 10 or 15 years ago. There were a lot of countries that had rates up close to ours, and there were a lot more countries that imposed a worldwide system. What's happened is the world has moved on without us. The world has made a huge effort to shift away from taxing income toward moving toward taxing consumption. And taxing consumption has huge advantages, and nearly every economist that I know will tell you that taxing consumption is a far more neutral way to tax. That is, it doesn't interfere with decisions to spend, decisions to invest, decisions to hire nearly as much as as income taxes do, or property taxes. Income taxes and property taxes both are hit very heavily on capital investment, on the margin. So they are disincentives to expanding and relocating in a jurisdiction. In 2017, our reliance on consumption tax-like principles was 17% of our tax base was consumption based. That consumption tax base is the U.S. state and local sales tax. Or we don't have a consumption tax on the federal level. Other OECD countries, their share of consumption taxes is now up to 32.5%, almost double what the U.S. is. They're gaining a competitive advantage that we were not. If any of you were following this debate in 2017, the House blueprint, you remember the border-adjusted tax, cash flow tax? There was a sense that you want to tax imports and exempt exports. That moved to more of a consumption-based tax principle. We didn't get that, but we got very close. We are now, the Tax Cuts and Jobs Act has moved us a little closer by 100% expensing and limit on interest, et cetera. And a lot of the issues that were passed in that act were linked together. It should be linked together if states conform. The other, the growth of our economy had been anemic, and I think this is a little bit old. I think in 2017 the growth was actually a little bit stronger than 2.3%. But as the previous speaker said, the impact of tariffs is a little bit concerning. We'll have to see 2019 to 2027. The hope was to get that over 3%. And I'm not going to comment on whether that's possible. That was the way that this act was going to be paid for, because essentially it was funded by through deficit financing. Transformational changes. I want to compare this with the 86 Tax Act. The 86 Tax Act, $100 billion of personal income tax cuts, financed by about $100 billion of corporate income tax increases. That's almost the opposite in the TCJA. $6 trillion over 10 years of tax cuts, but only financed by $4.5 trillion of tax increases. Where was the deficit going to be made up? The drafters hope that it will be economic growth. There was still a lot of concern over the hole that this blows in our deficit. 40% corporate tax rate cut. That puts us right about the average. The 21% is right about the average of the OECD. It also lowered the effective personal income tax rate, and that's key because there's a lot of our income earned, business income earned through the personal income tax, through pass-through income. And if you drop the corporate rate, you've got a real choice of entity concern for folks that are paying much higher personal income taxes. So they lowered the effective personal income tax rate, and they tried to create incentives to bring investment back to the U.S. And that is the focus that is important for states to keep in mind, is that states, when they conform, they do not conform to rate cuts. So that 40% rate cut does not go to states. States do conform automatically to base progress. This is the risk, absent any action by legislatures of states undercutting the purposes of the TCJA. So I want to reference this study that we did, Impact of Federal Tax Reform on State Corporate Income Taxes. It's on our website if you can't sleep one night, copy it down and take a look at it. It's got, it's a great recitation of the impact on every state of the various changes in the TCJA. TCJA ended up in a federal tax cut of about 10%. If states continue to conform the way they have been conforming in the past, they would end up with a state tax increase of about 12%. And again, that's because states do not conform to tax rate cuts, but they do conform to base progress. And the difficulty here is that this will transpire in the absence of any legislative action. So we have been talking to various state policymakers about what it is that your state should do to try and keep from undercutting the impact of the TCJA. And this is a great slide. This is just, it gives you a sense of what states conform to the various portions of the TCJA and how much they change the federal corporate tax base. The big one at the top is the one-time transition tax on unrepatriated foreign earnings. Remember I talked about the $2.3 trillion that was parked overseas? That is income that has been parked overseas since the 1986 Tax Act. So there's 30 years in many companies of income parked over there because they didn't want to bring it back and pay the 38%, the 35 plus state income tax rates on it. This one-time transition tax deems all of that 30 years worth of income as subpart F income. Remember, subpart F income means that it's immediately taxable. You don't have to bring it back. It's still over there. It's now taxed. It was taxed on a one-time transition tax in 2017, regardless of whether the company brought it back or not. What it does, though, it frees them up to bring it back if they want to without paying. So that transition tax, is offered at a very reduced rate, but it increased the foreign tax or the federal corporate base by about 9%. And states only partially conform to that. The two items that states conform to mostly are the next two: the net interest expense limitation, 30% interest, which I'll talk about on the domestic side, and then the global intangible low taxed income. And I still haven't discovered who in the Treasury Department came up with that acronym, GILTY, but they are very proud of themselves. And I will find out, because I think that person's name has not been released yet, but they are very proud of that acronym. GILTY is, it's sort of an effort to try and make sure that a company's worldwide tax income pays a certain amount, and I'll get more into that as we go. For state budgets, there's some good news and some bad news. The good news, well, for the Wayfair decision, unfortunately, that hasn't really helped Montana because of the no sales tax. The Wayfair decision came down in June and said basically that states can enforce sales tax collection even without a physical presence. But and certain states that do conform to certain portions of the TCJA will see an uptick in revenues that weren't there in prior years. The big concern is the federal deficit, the debt crisis. And the current concern there is that there's a lot of revenue sharing with states, that if the deficit keeps ballooning, there's a risk that may be cut back. So, and this all on top of the typical state difficulties, pension liabilities, infrastructure needs, rising healthcare costs, et cetera. Let me talk about there's 4 key international tax provisions. The transition tax I talked about briefly. Again, that was the only portion of the TCJA that were on that was effective in the 2017 tax year. So that was filed on corporate tax returns I guess October 15th, and incredibly difficult filing season. All of the other issues, the GILTY, the base erosion, the BEAT, which I'll get into in a minute, and then the FDII, the foreign derived intangible income, are all coming due in 2018. So they will be filed on the 2018 returns next due March and extended in October. Nobody in corporate America is looking forward to that filing season. That will be a nightmare, largely because there's not much advice on the federal level, much less advice on the state level as to how those issues will come through. I talked briefly about the one-time deemed repatriation transition tax. What we're recommending for states to do is that if states tax subpart F, then they should tax this in the same manner as subpart F. I think Montana, you tax about 20%. I think you've got 8% DRD, dividend received deduction for subpart F. That 20% is taxable in Montana. So Montana will get a big chunk of that if they continue to conform the way they have. Now, that 20% is apportionable. And what that means is that when you apportion, you have to put in the factors of the companies that earn that income, right? So, I talked earlier about avoiding double taxation. The way the states do it, obviously, is they apportion and they use a proxy for a company's presence in the state, property, payroll, and sales in the state versus property, payroll, and sales everywhere. Well, if you bring in this foreign income from subpart F, this huge amount of income that comes in, you've got to put in the denominator of your apportionment factor the factors of those foreign companies that earn that income. Now, that income was earned over 30 years, and very difficult to go back and recalculate what those factors were for each year. And that's going to be, and I know you guys are struggling with that. I'm sure that this will be an audit topic for many years to come, right?
I mean, we're leaning towards the situation. Sorry to interrupt.
No, I love it. Please do.
We're leaning towards the apportionment and allocation percentages for that year of filing, and not trying to recreate history for the 30 years on that.
What if a taxpayer has the records and gets a better result?
We would have to take a look at it. We haven't passed a rule, but that's what we're looking at, because we don't think that that's going to be identifiable. It's going to be hard to trace that income anyway.
Yeah,
I think regardless of the 30-year window.
Yeah,
So,
very, very difficult thing for taxpayers.
if they do, I would love to hire that accountant.
I think New Mexico is taking an approach whereby, and we were just discussing this, if a taxpayer did not want to go, or did not have the records to go through and trace the factors of, the factors behind that income, that they could then have just a 10% safe harbor. But and so that's one of the issues that's coming through on 965. Pay attention to that. Again, that's one of the issues that I think will crop up for the next several years. Just to give you a sense of how many states conform, the brown are those that adopt 965 but have some sort of DRD, dividend received deduction. That's it's like a haircut. So it's 80% excluded. The ones that have in green adopt 965, but they give 95% or more dividend received deduction. So it's largely a non-issue. Typically, if you look at a dividend received deduction, there's a haircut, 5, 10, 15, 20% for related expenses, and that's what that haircut is for. So that you don't have to get a double deduction. You get a deduction for the income, and then you get to double deduct the expense as well. I'm going to skip over this slide. Again, we may get into this, but in the interest of time. The base erosion and anti-abuse tax. This is an alternative minimum tax. Fortunately, not going to spend any time on. This comes through in a different portion of the Internal Revenue Code that states do not conform to. I'd be very surprised if states conform to this. You guys are not, obviously. So let's pass it. The biggie, the one that has a lot of folks worried, is the global intangible low tax income guilty. And again, this is as part of the effort to reduce the rate and to make our tax system competitive and fair, is to try and ensure that a minimum tax is paid on worldwide income. One of the big problems prior to the TCJA was profit shifting. You've heard stories of the double Dutch Irish and the Dutch Irish sandwich, and these were ways that companies were taking intangible income and moving it to jurisdictions where there was low tax. Well, two bad things there. One, companies, the U.S. didn't get that tax. The U.S. also didn't get the benefit of the intangibles there. Really terrible disincentives. So what they came up with is guilty is essentially, it's a bit of a random definition. They said, let's take a look at your tangible assets, and we'll give you a 10% return on your tangible assets. And then everything above that, we'll call that guilty, global intangible low tax income, whether it really is intangible or not. So there's some real, it's a kind of a random definition. And then in order to give a break, they'll provide an offsetting deduction that lowers the effective tax rate. Now that deduction, which we call the guilty exclusion, is a 50% exclusion of the tax base on the federal side. Now, and so it's not, and effectively on the federal side, that creates a rate reduction, but the states, again, if they don't pick up that base reduction, they are not giving that rate reduction. And that's another critical aspect. That base expansion comes through in section 250, which, I don't know if anybody, that's what we call a special deduction. The special deduction comes through in line 29 of the federal tax return. Some states start with line 28. And if you start with line 28, you miss line 29, you will bring in the entire amount of guilty without the guilty exclusion that's meant to be part of it. So that's one of the areas that it's a real trap for states that sit around and do nothing. I'm not going to get into some of this. The guilty, it is not just limited to intangibles. And when you take a look at the impact of guilty on the state side versus the federal side, vastly different. And you can look at this at your leisure. State conformity guilty, all over the map. We've got Montana excluding 80%. Basically, the green are those that decouple from guilty but give some sort of deduction. The blue states are states that are separate filing states that really would be constitutionally prohibited from conforming to guilty because of the prohibition against discriminating against interstate commerce or foreign commerce in this case. Very interesting map. We're still meeting with states to try and get them to decouple from guilty, and several states have done so to their credit, or at least decoupled to a large extent, and included. Guilty is not subpart F, but they treat it like subpart F in many cases. This is the separate reporting state crack precedent that they would have real difficulty conforming to guilty. And the same issue under the transition tax with respect to factor representation is there for guilty. And that is if states conform to the guilty income, then they have to allow factor representation in the denominator of their apportionment factor for all of those countries where that guilty income is earned. And again, you make the denominator bigger, it reduces your apportionment factor. But it's very difficult to determine how that guilty income is earned and which controlled foreign corporations are earning that guilty because the federal return is on a consolidated basis. There's some real issues here that I know Lee is going to be struggling with that in his audit team on guilty because incredibly complex tax structures, tiers of controlled foreign corporations that will be struggling with how to provide appropriate factor representation for guilty.
Yeah, we're still learning about guilty. Luckily, the state of Montana is a worldwide combined state, so if it's a unitary affiliate, that income would be already reported regardless on our returns as income. And there's exceptions to that with Water's Edge, which I won't get into because it's a little bit in the weeds. But
how many of your taxpayers actually file worldwide versus Water's Edge?
We have about 400 companies that file Water's Edge. We have about 13 to 16,000 corporations. Of those, the top 90% of the income is just very, very taxable income. It's a very small population in Montana.
So
I would say that I'd have to look to see how many of those file.
So those that file worldwide, they presumably have already paid income on the 965 transition tax as well.
Possibly.
We would say yes.
We'll have to look into that. I got some notes on the trend.
Yeah, no, that's there are some other states that have struggled with that. We had the same discussion with Oregon, and there was a recognition that, well, in Oregon, because in the state that went worldwide, there's a recognition that, well, they paid income on all that foreign income, and they therefore got rid of their taxes.
Yeah, I would say that we think that transaction tax for Montana, the 965, is going to be a minimal, very immaterial increase, if at all, because of the worldwide combined filing. I think they probably already put it in the last 30 years.
I think that's the right answer too. The other, the FDII, this is a really interesting, this is basically a patent box. This is meant to go with the with guilty, and the guilty is the stick. This is the carrot. What this is that this encourages companies to bring intangibles back to the U.S. and hold intangibles in the U.S. And if they do that, then income earned from those foreign-derived or income earned on the U.S. intangibles, foreign and used in foreign countries, get a significant tax reduction. And again, a great way to bring intangibles back to the U.S. instead of trying to stick them into a low tax jurisdiction and having the U.S. trying to get it in another manner. So the difficulty here is that the U.S. Can discriminate against foreign commerce. Specific states cannot. We're one of the things that we impress upon states is that it's very important that if you do try and conform to guilty, you also need to bring in the guilty exclusion, and you also need to adopt the FDII exclusion, the foreign derived intangible income, because that is what encourages companies to bring intangibles back to the U.S. and manage them here, and have employees here, and bring back jobs to the U.S. that were formerly in the overseas. This is again a chart that talks about states that decoupled from FDII fairly. Two domestic tax provisions I want to touch on very quickly. One is interest expense limitation. This is a 30% limitation on the deductibility of interest. And again, this is coupled with the next one, which is 100% bonus depreciation. Now, again, this is a consumption principle. It'll allow immediate expensing of anything that you buy. It puts us more toward a consumption camp. And what the drafters of the TCJA were concerned about was if you allow 100% bonus depreciation, they didn't want companies going out and borrowing a lot of money, getting the immediate deduction for depreciation, and then deducting all that interest as well. So there's a little bit of a war on debt here, but these two provisions should be tie-barred. They should be taken together. So the difficulty here is that neither of those two sections, where these come through the federal code, are new sections. So states already conform. The sections have changed. A lot of states don't conform to bonus depreciation because there's a lot of states have accelerated depreciation now. If they continue to conform, they will not conform to bonus depreciation. However, they will pick up the interest expense limitation. Again, those very unfair to limit the interest, but not allow 100% expensing, because those two were tie-barred and designed to encourage growth. And the 100% bonus depreciation is a true behavior driver. I mean, if folks can get an immediate deduction for investing, they will do so. Economists love this as far as trying to encourage growth. The bonus depreciation, this is the single most important issue in the TCJA as far as driving growth. And again, this is just a slide that shows the importance of making debt and acquisition of capital assets linked together. And, you know, this is more maps, state conforming 100% expensing. The brown states are states that do not adopt the revised 168K. You know, and I'm gonna stop here and let Lee, you know, there's a couple other issues, there's a whole list of individual provisions, but I'm gonna let Lee talk about those and Montana, please. And I reserve the right to interrupt him also.
It's nice to know that I'm in a familiar company. I just recently did a tax conference and did a presentation. And one of the CEOs of one of the companies came up to me and said, "Lee, that was the most boring presentation." And that was recent. So that wasn't my first presentation. Hopefully I will do a little better here. I just wanted to switch the gears a little bit. I do have a little bit of numbers in regards to how those deductions, whether we decouple from them in Montana, and the fiscal effect based on our estimations here a little bit later in the presentation. But I'll be brief for the most part. Well, that's okay. Right now, the last couple months have been very busy for the Department of Revenue because of the Tax Cuts and Reform Act. We call it HR 1. It affected not only our individual income tax, our pass-throughs, filings, and also our corporation taxes. The HR 1 was passed in December of 2017, and that was a very short time frame for us to make adjustments as they flow through to the state of Montana. One in particular that, while it's not necessarily germane to corporate tax, it is for payroll, is that the federal government did eliminate the federal exemptions at the individual level, which was problematic for the state of Montana because we use the W-4 for people to calculate their own tax liabilities and what they want to have held and paid to the state for their individual income tax. Well, since there isn't a federal W-4 anymore because they eliminated the federal exemptions, we had to create our own. And this is our first year with it. If you have any issues, or your payroll folks in your companies have any issues with it, we'd certainly be willing to listen in. Also, the federal government established a new 1040 style, it's more of a sectional style. I kind of applaud them, I kind of like the idea. It's like you grab paragraphs or pages of what applies to you instead of having to go through a list of things that necessarily don't apply to you. So you pick and choose the portions or schedules that applies to your certain situation. We wanted to go ahead and revamp our equivalents to 1040 as well. So we did, and we mirrored the sectional style because we thought it wasn't a bad idea, but mostly because we thought it would be easier for folks to only have to learn one new tax return instead of two, and ours tries to follow the federal return. There's a couple other things that we did along with the federal government. We eliminated our EZ form as well as the federal government. Just some things to talk about in regards to individual income tax, just some high-level changes that have come down at the federal level. That does affect us here in Montana. There's an increased limit on deduction of cash contributions. The floor medical expense deduction was decreased. SALT, which I think you had in your presentation, is limit to the itemized deductions for state and local taxes paid to the individuals. One that hits near and dear to my heart, interest on home equity loans is not deductible. I have a tendency to do my own carpentry, and again, and again, and again, so I continue to need home equity loans and the interest deduction that applies to that, so that one hurts. Mortgage interest deduction limited to interest of those large balance loans. And the miscellaneous expenses was changed as well. There's a couple other changes up to the above the line deductions that I thought I'd throw in there just because of the interest level. I find them interesting. Alimony paid is now not deductible if you're filing your return, but the alimony received is not taxable. Discharge of student debt is not considered taxable income. So in an unfortunate situation, if you had a student that had a lot of student debt, that can be discharged, but you don't necessarily have to claim that discharge. Now it's taxable income. And then moving expenses are not deductible as well, which kind of falls into our telecommunication discussions earlier. Business income tax reform. Doug hit on some of these. The full depreciation, which he discussed, which is 100% depreciation for any acquired property after that date. We feel that our estimates project, and Ed's folks project, that that'll have a negative fiscal impact somewhere in the area of $27.2 million in the first filing year of that. It'll slowly get less and less a negative impact to our budget, and ultimately we'll start reaping some rewards and actually have $11 million positive at the end of 2024. And how that works is you're depreciating your equipment immediately, or you're expensing your equipment immediately. So the depreciation that you would have had in those further years, you're not going to deduct because it's already gone, so the income levels and the deductions will decrease in our income levels.
Basically, timing difference, right?
Absolutely the timing difference. I liked what you said, consumption.
Yes. Yeah,
Consumption idea.
It creates an incentive for investment.
Absolutely. Expansion of expensing, you discussed that. Section 179, we feel that it will decrease our income that we'll have here in the state of Montana tax collections up to at least 2027. It's not that big of a move, but it's somewhere south of $1 million a year. And then you can't really see the full one on the other one, but the limitation of the interest deduction, which Doug also mentioned, is a little bit of a windfall for the state of Montana. $1 million, and it gradually goes up to $4.3 million in 2027. Probably one of the better explanations of guilty. We're still learning on guilty. The one thing that we need to look at is that whether that guilty income would be considered, if subpart F, or does it come in the form of a dividend? And that 80% exclusion that we have in our information, we considered it maybe coming in as a dividend and falling under our 80% exclusion in our corporation tax statute. It's accounting probably not very interesting to you folks, but it's something that we have to analyze and a hurdle that we're looking at.
No, I think the guilty will be a big issue, and it sounds like, Lee, that you guys are taking the right approach, and that is to treat it how you treated subpart F previously. And I think you allowed an 80% exclusion. The 20% for some companies will still be a huge amount because they've got 30 years of income saved up, and I think there will be some questions about how to offer factor representations that way.
Yeah, absolutely. The one thing about Montana is when you get into those factors where we try to apportion our share of income that becomes taxable in Montana, because we are a large state with a small population, our apportionment percentages get really, really low. So we just don't see much in the way of movement. And like I mentioned before, we think a lot of these companies have already reported that income in those prior 30 years because we're a worldwide combination state. So we did do some research on it, and we just don't see it. We may be wrong. We have been sometimes, but I don't think we will this time. Federal repatriation, I discussed that, and think that probably had already reported as well. Qualified business income. This was another fun analyzation and research project that we had. Qualified business income is a type of income. For the most part, it's all business income unless you have a service industry like an attorney's office or an accounting office that happens at the pass-through level. So if you made $100 in your pass-through company, the income would flow to the partner. Let's just say for ease, it's solely owned, you have one partner. It's a 20% exemption of the income that passes through to that one partner, just 20% off the top. We consider that an exemption for the most part, and we do not follow the federal exemptions or anything below the line in the state of Montana. So we decouple from that, and we do not allow and are not allowing that 20% decrease at the pass-through levels. There will be a lot of questions regarding that. We have a number of interpretations and reasonings behind that. For the most part, right now, though, we feel that that is an exemption. We do follow deductions at the federal level, but because we consider this an exemption, we do not follow that and have none of that.
And you know, this exemption on the federal level was done because the huge corporate tax rate reduction. If you have your business in a pass-through and they don't allow a 20% exemption, you would still pay the much higher individual income tax rates. And that would create a lot of tax planning opportunities with respect to choice of entity and you know, corporate C corporations already pay a double tax on their income, once when it's earned and once when it's distributed as a dividend. So in my mind, the individual could always be a little bit higher, and there still would be some rough parity. So it doesn't really impact Montana because Montana doesn't conform to the rates. They do conform to the base.
Right. Yeah, that's exactly it. I mean, we were trying to understand the genesis of this, and that's what we deduced as well. As it was a fallback, a decrease in corporate rates. It's kind of hard to do with pass-throughs because pass-throughs do not pay at their level. It flows through the individual. Therefore, we consider it an exemption. That's really all I had to say. Does anybody have any questions for Doug or myself?
This is your chance.
And I did not put questions.
No, I had questions on my list. I didn't need to. Yes, sir.
Doug, do you have a forecast or do you have any thoughts about what's going to happen with immediate expensing in 2026 as it phases out and gets to the point where everybody's going to have a bunch of depreciated personal property and no way to offset it when they sell it?
2026 is a lifetime away.
Yeah.
For tax folks. That's it. I don't. Yeah, that's really hard to judge. I think a lot of it will depend on how the economy does generally as to whether that will be renewed, the expensing. I mean, keep in mind that every time you buy something, you get the immediate expensing, and so I mean, unless I, for one, am very worried about the fact that I don't think the growth projections in the TCGA were realistic. I think there will need to be some sort of adjustment in order to deal with the deficit. But whether that is part of it, when that is one of the drivers of growth that economists do recognize, you know, this is something that it directly influences behavior. You buy it, you get a great deduction, and therefore you get an immediate reduction in your tax.
I'm curious as to why Montana has both worldwide and water's edge. I would think it would be, you know, we want to simplify and expedite our tax system. It seems to be worldwide would be just simpler and more effective.
So that's a great question, and I'm really happy to address that. So, and I have been, you know, sort of a student of state tax for years, and I'll be the first to admit that a worldwide system looks very elegant in theory. It's a straight mathematical formula. You take what you earn in Montana, and that's in your numerator. You take what you earn everywhere else, and that's in your denominator. You get a fraction, and you multiply it by the total income. In practice, it is very, very difficult to comply with, and even on a water's edge basis, because it is a decision that, well, first of all, it is a constitutional concept, the concept of unitary, and the Supreme Court has given very vague guidance. 3 terms: functional integration, economies of scale, centralized management. Now, I don't know what functional integration looks like, or centralized management. Or do you need all 3? And so some of the audits with respect to the unitary calculation, when I was at GE, we fought an audit in California for 20 years. And this was whether GE and GE Capital and NBC were unitary. And because, that answer should be black and white. You should be able to say you're unitary or you're not unitary. Well, that's a decision that is made up at the C-suite level. So during the audit, we even had to depose Jack Welch and get a statement from him. What did he mean to do when he bought NBC? Did he mean to integrate it or not? I mean, that's it was very, very difficult, very time-consuming, and very, very expensive audits that came out of it. Now, when you put in the worldwide component, what happens is that then the last time this was tried, worldwide was tried back in it was first found constitutional in a case called Container in the 80s. And a lot of states, California, led by California, adopted it, and immediately created a huge outcry from some of our largest trading partners. The UK felt like their companies were being penalized for issues that took place completely outside of the United States. Why should what happens in the UK impact how much tax they pay in Montana? So as a result of that, they threatened retaliatory tax against United States companies for the U.S. if they imposed mandatory worldwide combination. Japan threatened retaliatory taxes. It was one of those issues that was ultimately resolved by offering a water's edge election and saying, look, it is more important that we just consider what is impacted in the U.S. versus what is impacted, worldwide. And this is it's a debate that continues to go on. But I know it's active here in Montana. But if you've ever been through an effort to try and comply with a unitary return, or 2, go through an audit for a unitary return, it can be truly a nightmare. So, and the fear on worldwide, when you look at some of the different economic systems in different countries and the inflation rates in companies like Brazil or Argentina, which at times were a couple 100,000% per year, it's very, very difficult to get some sort of apples and apples comparison of their systems to ours, which makes worldwide a very, very dicey proposition. I hope that is I'd love to talk to you this for hours. I can tell you that.
Unfortunately, we won't have that. Well,
Is U.S. now going to a territorial system like most of it? Is that getting us there? Are we there, or what? And how does that affect water's edge anyway?
Yeah, so that's a great point. I talked. There's 2 ways to avoid double tax, right? And that is allow a credit for taxes paid elsewhere if you pay worldwide, or this is a let me see. So on the federal level, we do it with a credit system. That is, or we used to. You pay tax in the UK, and then you get a credit when you pay tax on that same income in the U.S. At the state level, we apportion, as I said before, the apportionment. The distinction between worldwide and water's edge really depends on what goes in the denominator. And if the denominator is water's edge, it's just the water's edge entities. If it's worldwide, it's all of the entities. And of course, the income of that, income and losses go into that calculation as well. One of the companies that was a big proponent of worldwide when it was first introduced in California was Disney. Now Disney, because Euro Disney was losing hundreds of millions of dollars annually, they wanted to include that in their apportionment factor, and that wiped out their California tax. So there are winners and losers in the worldwide computation. On the federal side, what we have done is we have gone to what we call a quasi-territorial. We're still now looking at what you earn in the U.S., but they're also imposing the BEAT, which is an alternative minimum tax, and then GILTI, which is in a sense a tax to make sure that your worldwide income is paying something, right? And so it is a little bit of a makeup. Yeah, it's a little bit of a hybrid. It doesn't get us completely to territorial, but it's a huge improvement from where we were before. My view.
All right, well, thank you very much, gentlemen. Thank you, yes, Doug.
Awesome. Thank you.
In addition to this, as a visitor, we have Charlie Russell.
I'm in this museum. That's awesome. Yeah.
And Lee.